Hi guys, today we are going to be talking about how to plan for your small business. Welcome to my financial literacy channel where my aim is to empower, inform, and provide the agency to support Canadians from negatives to millions. You can find out more or connect with me in the links below. So, the first thing anyone's going to ask is, do I incorporate or do I stay as a sole proprietorship? The really big question to ask yourself around this really has to do with two things. Number one, do you have liabilities? So, if you are running a business where somebody has the potential to sue you, or this is a really high risk venture, and you want to make sure that in the event you go bankrupt, nobody can come after your personal assets, incorporation is absolutely key. On the other hand, if you are just starting up a new business and you don't have a lot of income yet, you can write off basically everything. Maybe there are no staff involved. You don't think there's that much risk. Then you may as well skip the expense of incorporating, because to incorporate, you're going to have to go to a lawyer. You're going to have to get documents written up. You're going to have to get those registered with the government. And then every year thereafter, you have to pay to re-register your corporation. And you also have to make sure that you're paying for corporate taxes. So either that means paying an accountant to do your tax filing for you, and corporate taxes are more expensive than personal taxes, or it means going through your own tax filing, which can be quite a bit more complicated than if you were just a sole proprietor. So a couple reasons to incorporate, a couple reasons against. The major drive for incorporation usually for people has to do with the tax savings. So there are a number of tax planning things that you can do if you are incorporated. For example, you can choose how you pay yourself. So you, instead of just taking regular salary and paying CPP and paying EI, you can skip that altogether and just pay yourself dividends. So dividends would be a flow through of profit to yourself, which you can also share with any other shareholders. So if multiple people are in on the business with you, it provides the opportunity for you to do some tax planning and spread out the income the way that you choose. The other benefit to an incorporation is obviously that you can keep cash in your corporation and you don't have to withdraw it. Obviously, the Canadian government, if you guys remember a couple years ago, put in place a couple stopgaps to make sure that you're not holding too much money in your corporation. But really, the threshold there is like if you have over $1 million in assets. The other thing to consider is that if you have any cash sitting in your corporation, passive income, so interest earned or things that aren't income that isn't earned from your regular business activity, is actually taxed significantly higher, almost half, than it would be if you're holding it personally. Last consideration around incorporation is if you intend to sell. It's awfully difficult to sell a sole proprietorship. You'd be selling any assets you have, maybe client lists. You might be selling basically your goodwill and good name. But a corporation, because it's its own entity, you can actually sell this. You can either get investors to buy in and buy shares from you, or you can sell the corporation as it is, and possibly earn capital gains at the end of the day if you're selling an incorporation. So the number one risk to a new business is actually cash flow, because obviously your income is going to be a little bit variable. Your expenses are going to be all over the place. There's a lot of startup costs when it comes down to a business. A lot of people like to focus on the cost of a website, etc. But I mean, even just investing in technology for your particular industry, investing in marketing, getting yourself a logo done, all of those different things cost money. I've worked with a lot of business owners over my decade plus in the industry, and let me tell you, almost every single one of them has an inconsistent cash flow, at least for the first couple of years until their business gets really settled. So you want to be prepared for this as best as possible by having really big reserves if you can. So this means saving as much as you can in advance. This means having access to any lines of credit or loans, ideally before you take the leap. Because if you are already making good income, you have a job, and you're thinking of, turning that side hustle or that dream into a reality, if you can apply for credit while you still look like a good candidate, then you will actually have some access. If you take the leap and you haven't been making any money for a year or two, then it's going to be awfully hard for you to qualify for a regular line of credit or a loan in your name before you have some proof of income, really. what your goal is to have somewhere between 6 to 12 months of expenses. Now, for a regular family, what my suggestion is usually between 3 months and 6 months worth of savings. But for a small business that is relying on you to make money effectively, the larger the reserve, the safer you are. Again, this provides you with options if there are needs that you have to spend on, if there's a reinvestment that you need to be ready for. Your taxes obviously are now going to come out of your pocket. So having the largest reserve possible, or a larger reserve than you would otherwise go for, is ideal. A lot of people are like, oh, well, I want my money to be working for me. I want it to be in the markets. Well, you're not going to actually earn that much over the course of the year. No investment advisor worth their salt is going to let you use reserve money in the actual stock market, because you need it possibly within the next year, and we can't guarantee whether it's going to go up or down. That being said, high interest savings would be your best way to go. So either you keep it in your regular checking account, your regular savings account, or if you're like me and you need to separate that from your spending account, you can open a high interest savings to earn as much as possible. I would highly advise against going for a tax-free savings account. The reason for this is that as much as a TFSA sounds like a savings account, you're actually using up registered contribution room and potentially eating into that when you withdraw as well. So you don't really want to screw with your contribution room, because you can use that for longer term planning, bigger investments, and that sort of thing, especially because we assume in a reserve fund sort of situation that you're going to be putting money in and taking money out on the regular. Your RRSPs are actually not a bad source of income for you, or not a bad source of reserve fund. And I'll tell you why. The RRSP, as it works, basically provides you with a reduction to your income when you're putting money in. So you get the taxes back. When you're pulling money out of your RRSP, it gets added to your income. If you are like many new business owners and your income is a big fat 0 or 10 grand or something like that, pulling out an extra 20,000 or 30,000 from your RRSPs is almost the same as earning that in salary. So in Canada, we have a graduated tax system, and the first 15,000 usually is not taxed at all. And then afterwards, once you're getting into $30,000 per year, the tax is marginal. So you might pay a couple grand tops in terms of taking out and accessing this RRSP money that will help you fund your dreams. If this cost is worth it to you at the end of the day, because you're obviously planning on making more in the business, then it's not a bad source. That being said, really important, what I said earlier about not having your money in the market is, if you're going to be using your RRSPs as a true reserve, you need to make sure that you change the style of investment. Something just super, super conservative, money market, cash, GICs, that kind of thing, so that you don't have to worry about losing the capital that you're relying on. So how do you calculate how much reserve you actually need? We talked about 6 to 12 months, but what does that mean for you? The way to figure out what you need for a reserve is by looking at your expenses. So what do you have to spend every single month? Also, what do you have to spend on bigger ticket items throughout the year? So as a lawyer, for example, you may have your regular overhead, your office, your maybe your admin staff, that kind of thing. But what you are not considering, or something that also needs to be baked in, are your licensing renewal fees, your insurances, those things that only come up once a year. The way to do that is basically to add it in and divide it by 12. One of the easiest things that you can do for yourself, since you own your business, is to build your salary into those expenses. Because then that means that not only do you have a business reserve, but you have your own expenses covered as well, so that your family, your household can run whether or not you happen to have a dry month, or whether or not a client happens to take a few too many months to pay you, or whatever it is. Speaking of expenses, another big question always comes down to bookkeeping. The easiest thing you can do for yourself is to separate out your personal from your business expenses. Your accountant will thank you, your bookkeeper will thank you will thank you, because it will be very obvious what you are spending on the business versus what you are spending on yourself. This is important for a couple reasons. Obviously, your business expenses are what reduce the income that your overall business is earning. In the event that you are using credit, so credit cards, if you're dipping into lines of credit, if you're dipping into loans, anything like that, another thing to be aware of is that interest paid on business expenses or business loans is also a deduction. So you want to make sure that those, like any credit cards that you have or loans or whatever, are specifically business related. So then you don't have to do any fancy math. All you need to do is pull statements at the end of the year and say, this is how much interest I paid. This is how much interest I can write off of my total business earnings, which is, again, good for you and good for your tax situation. The other thing that keeping things separate allows you to do is your own planning. We were talking about expenses before. It's really easy to assume what you're spending. It's really easy to kind of do round math. It's another thing altogether to actually look at the hard numbers on your monthly bank account statements, on your monthly credit card statements, and see, my actual business expenses might be $1,500 a month more than I was thinking. But now you have it all on paper. You have it in one quick and easy location. Again, both for any of your accounting or bookkeeping team, as well as for yourself. All right, the last thing I'm going to get into is how to source extra money. So there's a few different options you have. Number one is outside investors. So if you can get somebody to buy into your business, if you have a corporation, you can sell them shares, or you can structure a loan, for example. If you are looking at loans from the bank, then that might be a little bit more difficult to secure, as I was mentioning, if you don't have the cash flow. But if you do have a proven business model, if you do have perhaps income from other sources or previous years, then you would be able to qualify. The thing to be aware of is that any business loan that you take out is probably going to be guaranteed by you yourself. So as much as there is the separation between the incorporation and yourself personally, while your business is a new baby, the banks are going to ask you personally to make sure that this baby is still covered and still paid for. In terms of extra funding from the government or from grants or whatever, there's two quick things I want to mention. You can qualify for and apply for grants. If you go to the canada.ca website, you can actually look for, there's a grant page that allows you to put in your business story and finds you a couple grants that you might be able to qualify for. One of the other resources that we have access to in Canada is the Canadian Federation of Independent Businesses, or the CFIB. The CFIB will provide coaching resources, loans, etc., to businesses in order to help support them. The thing is, obviously, you still need to qualify. Most of those things come with costs, but they're usually willing to create a program so that your business can afford it, because they understand that new businesses often have cash flow problems. So I hope this video provided you with some good insights. Don't forget to like, subscribe, or comment for more about your money. If your questions are larger than the contents of this video, please reach out to the certified financial planner in your life for more professional direction. Or if you need, you can contact me by text, by email, or by setting up a free half-an-hour conversation to point you in the right direction. I am taking on new clients, and I am always happy to help. Until next time, wishing you financial security and success.